When should you realize capital gains? This is a tough one. Nobody ever wants to voluntarily pay taxes. That being said, I never want to let the tax tail wag the investing dog, right? We need to set portfolios up that are in alignment with our risk tolerance, our goals, so on and so forth. You know, Oftentimes I'll see clients roll in new accounts and they are far more aggressive than I want them to be. Also, kind of as a side note, I happen to think the stock market's very, very expensive today. I'll see clients roll in portfolios as much as 95% equities for people at or near retirement, way higher than I want them to be. But they're sitting on some capital gains. So we have to come up with a strategy to reduce that risk, which means realizing capital gains. But we want to balance that by not paying too much too quick. So I want to kind of walk you through some of those considerations in this video today and talk about some examples that I've seen. My name is Scott Caulfield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. Let's start by looking at the taxes you're going to pay and how capital gains are going to figure into that. So, first of all, there's just the capital gains tax. If you're in that 0% rate, that's a great time to realize capital gains. This happens sometimes when people are early in retirement. Let's say they've retired, so they're no longer drawing any income, but they're not pulling Social Security yet. That's often a golden planning opportunity. We can realize capital gains without paying any tax, or you can do things like Roth conversions. But that does not apply to many people. So we'll kind of skip past it. Most people are going to be in this 15% tax rate range. That's going to be the vast majority of taxpayers. Most of the clients I see, some high net worth are going to fall into the 20% tax rate. Now, it's not just as simple. Most people always assume capital gains, oh, it's just 15%. But there's also the net investment income tax, the NIIT. Now, that is going to be an extra 3.8%. So for those in the 15% rate who are tacked on with this, they're going to be actually paying an 18.8% capital gains tax. And for those at the 20, obviously it's going to be 20 plus the 3.8, so 23.8%. Now the thresholds kick in on this lower than the thresholds, at least for that 20%. So you can kind of see it here. Usually 20,000 single, 250 married, but that's an extra consideration. So sometimes, that's another thing. If you're kind of close to one of these thresholds, oh, my capital gains might bump me over, say 250,000 married filing jointly. Maybe you try to spread it out into years where you can kind of get under that extra 3.8%. There's a little food for thought. There's one other aspect that I think a lot of people don't really take into account, and that's going to be your Medicare surcharges. So these income related monthly adjustment amounts, also known as IRMA. And what's tricky about these IRMA adjustments, they kick on prior years' taxable income or adjusted gross income, and we don't know the thresholds. So you kind of just go in based on what it's been in the past, apply a little guesstimate for inflation to kind of plan around that. You can see where these are going to kind of add in for people. It's generally going to be higher income, but these do kind of add in a pretty significant monthly amount. And if you think you might be close to a break point, you might take that into account for your capital gains realization strategy. So obviously we don't want to voluntarily pay taxes, or we want to at least minimize what we're paying. So that does factor into the plan. That being said, like I said, we don't want to let just tax implications kind of swamp an ideal investment portfolio. We don't want to be stuck in something that is leaving you way too exposed to risk or just in a kind of suboptimal portfolio. And why I think this is challenging is there's really not a hard and fast rule. It's not like, oh, do this percentage on these dates. We're dealing with unknowns. The tax code is somewhat unknown in the future, even though we've got maybe a little better insight into that, but things always change. But what happens in the market is obviously the big unknown. If I think markets are too risky today and I want to see you reduce exposure, we don't reduce exposure. Oh man, if it goes down, that's really painful. But what if we do reduce exposure and it keeps going up? So we're dealing with this unknown future. There's not any perfect answer. That being said, we want to try to kind of get to the ideal portfolio without taking too much tax pain. Example I recently saw, a client came in, they had a $1 million taxable portfolio. Um, about 300,000 of that was capital gains. Now, in these capital gains, the bulk of it was really in one fund. So this fund had like 300,000 of market value, and almost 200,000 of that was capital gains. The remainder of their equity exposure, and they were like 95% in equities. And again, this is the client's at or near retirement. So, I wanted to see that lower anyways. And then given my market views, wanted to see it much lower. Now, the rest of that portfolio was only about 100,000 of capital gain. The way that we kind of planned on splitting this up is, hey, let's take the rest of that portfolio. Let's try to liquidate that over a couple of years. And, that was only going to have 50,000, 60,000 of capital gains per year. And yet that's going to reduce our equity exposure by 60%. Just a huge, huge amount. So, gets it much more reasonable, gets us all that capital that we can kind of invest as we see fit for the rest of that portfolio, while the capital gain hit wasn't too bad. Not ideal. Nobody kind of wants to voluntarily pay those taxes. Having an extra 50,000, 60,000 of capital gains in their case is not life changing. It's something that they'll be able to handle. And then the portfolio is going to be much more in alignment with their risk tolerance, their goals, and what we're trying to achieve. Now, the kind of the bulk of that other 300,000, the bulk of the capital gains, that's something that we'll kind of evaluate more down the road, see if we have any opportunities to realize in years where maybe their taxable income is going to be especially low. There's no perfect answer for people. You kind of have to look at your tax situation, your portfolio, where it's at versus where you're trying to be. And the more out of alignment with where you're trying to be, kind of the more you're going to have to take a little bit of pain and realize those capital gains and pay those taxes. Another situation I see commonly is people that have really large single stock portfolios. So, a lot of times this will happen if you're paid in RSUs or incentive stock options. Here in the Seattle area, you see this a lot with Amazon employees, Microsoft employees. They've been getting RSUs for years, sometimes decades. They don't sell. Good news, Microsoft, Amazon stocks have been phenomenal performers over the last decade. So it's not uncommon to see somebody with $1 million portfolio. It's almost all Amazon stock. And of that $1 million portfolio, they might have 700,000, 800,000 in capital gains. Now, this is especially problematic because the prior example I gave of $1 million portfolio, that was in mutual funds. Capital gains weren't that high relative to kind of their appreciation over time because those mutual funds had paid out capital gains distributions over time. Which, side note, that's one of the drawbacks of mutual funds versus an ETF. But these single stock portfolios, I mean, you've got the added problem of that's huge risk in just that one stock. I mean, if you work for Amazon and the bulk of your liquid net worth is in Amazon, that's obviously very problematic. To the extent you're planning in that kind of scenario, you obviously want to drastically reduce that. Yet you've got really big capital gains you're going to have to pay. This is one of those ones, there's no perfect answer, but I tend to like seeing people kind of pick a certain multi-year plan. Let's say we're going to realize or liquidate most of this over, say, 4 years, 5 years, something like that. Unless there's a unique tax feature where you're going to have either some higher taxable income years or lower taxable income years where you want to shift things around. If you're going to expect a pretty steady state tax situation, that's one of those ones where I just say, we got to kind of take our medicine and kind of fix this portfolio going forward. Not that I have any huge problems with like an Amazon or a Microsoft, but your company, you never know. It could be the next Enron. Things have happened historically, right? We're just trying to take these tail risks out. We want to diversify. There's a reason we don't want to put all our eggs in one basket. That could be catastrophic to your financial future. I realize it can be challenging trying to balance, not wanting to pay taxes, but your portfolio might be out of alignment. In general, I just really don't want to see that portfolio way far away from where it should be. If your risk tolerance says, gee, I should be 50% in equities and you're more like 90%, I would much rather see you kind of take a little bit of a tax hit, at least over a couple of years, and move closer to that. Because the damage that could be done by a 90% equity portfolio taking a huge hit can just be catastrophic to your retirement. So if you're way out of alignment there, that's something I just really like to see get rectified. And I think a lot of people are increasingly tax conscious, which is fantastic. We all should be. You don't want to let that fear of taxes leave you kind of overexposed. And the flip side too, some people are too blasé. They're just saying, "Oh, I don't care about taxes at all." And you want to be strategic with how you're doing this. Don't load it all into one year. You're much better spreading it out over a couple taxable years so that you're not hitting some of those other breakpoints. If you can avoid the net investment income tax, if you can kind of play around with your IRMA if you're already over 65 and those kind of things to help get those things down. So appreciate if you like this video, subscribe to my channel and share it with anyone you think would benefit. Thanks.